It was bound to happen. What goes up too fast also comes down fast. We have been too used to the fact that corrections are seldom, and they happen. And when they happen abruptly, because the market is very exposed to high cyclicals, to very aggressive beta. This is normal. This doesn't mean that the general trends of GDP growth, of improvement in the economies is changing. In fact, it is not. It is actually very likely that we will see a little bit of improvement in some of the economies, particularly in emerging markets and in developed economies. The numbers in the United States are also positive. However, what we cannot expect is that elevated valuations are going to continue when we start to see some things that don't match. And the first one, earnings estimates. We have seen earnings revisions are not going to be as aggressive as we saw in previous years. And more importantly, the earnings season so far is showing that banks are giving results that are nothing to write home about. Cyclicals, particularly energy, in which the market is extremely exposed, also giving results that are not showing that extreme recovery that some people are expecting in earnings and margins. And also this general trend of higher inflation, lower dollar, to which the market is overexposed. Therefore, what we need to be is a little bit prudent. Simply take this as the confirmation of a market that was possibly way too optimistic, that risk is coming back. Important to note that money supply growth is going below nominal GDP growth, for example, in the United States. Therefore, we cannot expect higher valuations, high multiple increases. And what we need to see is simply that valuations get more normalized and that the market gets used to higher rates, which is perfectly normal and actually extremely healthy. What we need to see is this improvement in the economies start to catch up with central bank policies, and central bank policies to see that they actually do what they have to do, which is to normalize, really normalize their policy.